Yeah, the current macro setup couldn't be better, right? With valuations stretched as high as they are, historically speaking, again, anything can happen year by year, right? And I'm not here to say that equities are going to do poor this year or even poor next year. We're not big on predicting the future, right? Nobody can accurately predict the future at all time. But what I think investors should focus on and advisors should focus on is preparing for the future, regardless of what happens.
I'm your host, Melanie Schaefer. Welcome to Lead Leg Live. The stocks are trading near all-time highs, but underneath the surface, many investors are tightening risk controls as global growth forecasts move lower and uncertainty over policy remains elevated. The latest global outlook from the International Monetary Fund sees growth slipping and flags rising risks of a disorderly correction. My guest today is Brad Barrie, co-founder, managing director, and chief investment officer at Dynamic Wealth Group. Brad and his team manage the Dynamic Alpha Macro Fund, a global macro strategy built for times exactly like this. Brad, it's great to have you here.
Thank you, Melanie. Pleasure.
So let's start on a theme. Many have just celebrated Halloween. You've said that there are lessons from Halloween that actually apply to investing. What do you mean by that? And how does it connect to how you run money?
Very much so. Yeah, I appreciate the question. First off, I would start with creating analogies with investing to things that everyone is familiar with is a great way to take away the scariness, if you will, of investing, right? Because in our industry, we can use a lot of jargon and a lot of mumbo jumbo, and it can scare investors. And as an investor in general, you don't want to be scared, right? You don't want to have a scary portfolio, even though it is Halloween season. So using analogies is a great way for investors and advisors in general to put things in perspective so that they can understand it. I think one of the key lessons with Halloween and investing that it can teach us is diversification. You know, if you think about it, if there was only one type of candy in the world, it wouldn't be a great world, right? I mean, you need to have a variety of candy. When you go trick or treating as a child or as an adult, to each his own, you want to get a variety of different candy, and that's part of the fun, right? And investing is the same way. You want to have a variety of different types of investing. We run a global macro fund. It's definitely one of the flavors we think investors should have in their portfolio basket, if you will.
Yeah, and to get a little bit more into that, you've compared diversification to a bowl of chocolate. I love the analogy. Can you walk us through what real diversification looks like? Because it's more than just mixing large caps and bonds.
Absolutely, right. It's again, we like labels in our industry, but when it boils down to it, the technical term is correlation, right? How similar are other things, right? And I was a financial advisor for 20 years, and I had many conversations with investors. And I would say, if everything in your portfolio is going up at the same time, it usually means everything will go down at the same time. And my clients they're smart. They figured that out. They would finish that sentence with me. And so we think true diversification is having non-correlated investments. And again, if we tie it to Halloween, one of the great combinations in candy is Reese's peanut butter cups. Taking something that's sweet and yummy and combining it with something that's salty and yummy, peanut butter, the two together make each better, right? And that's the same thing with investing, is having, not just stocks, because from a global macro standpoint, if there's a pullback, it largely won't matter if it's what sector of stock or large or mid or small. If there's a global pullback, they're highly correlated. And having something that's non-correlated, like a global macro strategy, can really help to add that diversification and make the end deliverable, candy in this case, even better, with kind of the salt and the sweet kind of combined in one.
So to carry a little on that point a little further, for viewers, who might not live and breathe this every day, what exactly is a global macro strategy, and how is it different from a traditional balanced or tactical allocation?
It's a great question, right? Global macros thrown out there. I like to keep things very simple. Break it down into two words, global and macro. Global means anything and everything in the globe. It could be stocks, it could be bonds, it could be commodities, it could be precious metals, it could be agriculture, anything and everything. But it's not, as the name of that recent movie, everything, everywhere, all at once, right? So with our approach, we're very selective, and it's not having everything in the portfolio. It's understanding where are the supply and demand imbalances in the macro picture and being able to identify those and take actions or exposure when appropriate. So we don't have to be in everything, everywhere, all at once. You don't want to do that, obviously. You want to be able to get into things and take kind of that macro picture. And again, that's global. So what does macro mean? Macro means big picture. So we're not focused on stock by stock. Is Apple better than Google, better than Microsoft? It's looking at the big picture themes, if you will. Example of a theme could be the growth of the need for electricity in the world, whether it because of electric vehicles, because of AI, data centers, population development, you name it, right? A micro focus could be picking winners and losers, right? Is it going to be this electric company, this electric vehicle company, this, AI company? But a macro picture would say, what do all those need? All those need electricity. Well, what do you need to transfer electricity? You need copper, right? So long term, we're optimistic on copper. We don't currently have a position on copper because we also take technicals and price moves and other things into the equation. But long-term thematic, copper is something that we like. That's a macro example of what we talk about.
Right. So my next question, you've touched on this just a little bit right now, but why should someone consider adding a global macro component to their portfolio right now? Talking specifically about, what problems does it solve in today's environment?
Great question. High level, it solves two main problems. One is diversification, which I touched on. Traditional diversification, or sometimes we also call it basic asset diversification, or BAD for short, tends to be a portfolio. It might look like a bunch of pretty little colors, but in reality, when you look at the correlation over the last 15 years, it's really two main colors. And then if you look at 2022, when we really needed diversification, it was really one color, right? Global macro, on the other hand, can provide diversification over that 14, 15-year time frame, as well as years like 2022, when both stocks and bonds and international all went down. Global macro was non-correlated, performed very well. So the need for diversification is one, but also, again, we're Halloween season. The market is scary valuations, right? We have very scary high valuations. The Shiller PE CAPE ratio is a cyclically adjusted valuation metric. We're at about 40 right now, which is historically extremely high. And when you look at the analysis on this type of scatter plot, what you see is when you start with high valuations, the S&P 500's future 5-year returns are very muted. We're near zero. But when you compare that to global macro as a strategy, when you start with high valuations in equities, tends to perform very well. If you look at midline valuations, normalized valuations, what you also see is global macro does in line with stocks. And yes, if you look at the chart and you see that all the way to the left, that when equity valuations start really, really low, because quite honestly, they had the snot beat out of them, yes, equities will outperform global macro. But that's why in our mutual fund, the Dynamic Alpha Macro Fund, ticker symbol DYMIX, DYMIX, everything we do is macro, but we have a macro exposure to stocks at all times. And we have the global macro long short futures exposure as well to try to take advantage of all sides of investing from a macro side.
Okay. And you've talked about why now matters. The timing the market isn't about guessing direction, but recognizing cycles. What can you tell our viewers about the current macro setup and what that tells you about the moment for global macro?
Yeah, the current macro setup couldn't be better, right? With valuations stretched as high as they are, historically speaking, again, anything can happen year by year, right? And I'm not here to say that equities are going to do poor this year or even poor next year. We're not big on predicting the future, right? Nobody can accurately predict the future at all time. But what I think investors should focus on and advisors should focus on is preparing for the future, regardless of what happens. And you prepare for the future by having multiple drivers of return, right? And look, we all hope for the best, right? We all hope the market continues to do well. And we hope for positive trade deals and we hope for positive government actions, right? But hope is not a plan, right? If you're banking on hope, hope is not a solid plan. You have to be prepared for a range of possible outcomes. And that to me is what global macro investing is all about. Being tactical, being flexible, looking for supply and demand imbalances. And when the volatility is high and valuations are high, macro investing is ripe for taking advantage of opportunities to help investors, especially the way that we do it, which is differentiated, focused on a fundamental approach. We're not focused on quant or black box or trend following. It's not what we do. We complement those strategies actually because we're non-correlated to those strategies. But with our fundamental discretionary approach, now is a perfect time for taking advantage of strategy like that.
Yeah, and then so next I wanted to talk about the how. If an investor or an advisor wants to allocate to a strategy like yours, what's the practical way to do it, and how does a fund like Dynamic Alpha Macro fit into a diversified portfolio?
Great question. And it's really why we launched the mutual fund to make this type of strategy available to retail investors and financial advisors alike, bringing this kind of high level institutional type of strategy to everybody, right? What we see advisors doing from an allocation standpoint, because we're a little unique in the alternative space. A lot of alternatives would be more bond-like, lower return, low volatility type of strategy. Our volatility over time tends to match equities. So our goal as a fund is to deliver equity-like performance or better with low correlation to equities. So we see advisors allocating from equities into our fund, allocating from multi-strategy funds, so maybe a balanced fund, a multi-asset fund, other alternatives into our fund Dymix. If you look at our returns, and we'll share the results on the screen, but our numbers have been able to deliver what our target has been, right? Where you look at our statistics and you'll see that our returns have matched or actually beaten the S&P 500 year to date. Our since inception is slightly more than the S&P, which we're very proud of. Equally, if not more proud of, is our non-correlation and our risk measures. So again, our non-correlation to the S&P 500 is 0.26. And again, not to get too technical, but there's something called upside downside capture ratio, which simplistically tells us if the market goes up, how much on average do you go up? And if the market goes down, how much on average do you go down from a historical standpoint? And we're a little over 70% upside capture with about a 19% downside capture. And in the long run, if you think about it, as long as you're capturing more up than you are on the downside, that can lead to outperformance. And by protecting on the downside, it can really help to just target a smoother return experience. And that's at the end of the day, what investing should be all about, right? Generating more consistent returns. They really help investors and advisors meet their goals.
It's a fantastic explanation. Brad, before we wrap up, for anyone watching who wants to read more, see more of the brochure that we have been showing, see the full framework for Dynamic Alpha Macro Fund, where can they find the brochure? Where can they connect with you?
Absolutely. So you can go to our main website, dynamicwg.com. You can find our brochure there. I post on LinkedIn regularly, as well as Twitter, as well as a Substack. We have a Substack. If you can go to our Substack, just search Dynamic Wealth Group on Substack, and you can subscribe to our regular posts. I also put out regular short videos once a week on LinkedIn. Feel free to reach out. We're always happy to talk to anyone.
Brad, thanks so much for joining me, and thanks to everyone for watching. Be sure to like, share, and subscribe for more episodes of Lead Like Live.